Yeah, the goal of $15,000 an ounce, it comes out of three different analyses that actually don't correlate to each other. In other words, you do it one way, you get a number, you do it another way, you get a number, you do it a third way, you get a number. It was interesting that they all came out not exactly to the penny, but very close to that $15,000 number. So the first way to do it is just, it's a little bit of technical analysis, not overly technical. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. That was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store of value. So it's really only since 1971 when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn out, almost 20-year bear market from 1980 to 1999, and gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level. But you could tell it was the bottom. You say, well, how do you know that? I had a conversation with our friend Jim Rogers, one of the greatest traders in general, and certainly one of the greatest commodity traders of all time. And this was before that market bottom, when it was still going down. And I said, Jim, we were down in the Dominican Republic. I said, Jim, you buying gold? And he said, no. He said, I've got gold. I'm keeping the gold I have. I'm not buying more right now because it hasn't hit bottom. And then he gave me one of the best pieces of advice I've ever had. He said, Jim, nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, you have to expect that. It's true of all commodities. Well, taking that advice, I then, looked at the charts. Well, starting at 1900, if you say, okay, it was 250, it was 1999. 1900 was August 2011. So there was that gain. 250 to 1900. So there was that gain of $1,650 an ounce of gain. Take half of that, that's 825. So take 1900 minus 825, and guess where you come out? You come out right at 1075. And so when I saw 1050, I said, bingo, there's the 50% drawdown. It's exactly what Jim Rogers said would happen. That's the bottom, and it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000% and the second bull market was up 700%, if you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from where from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 8 years. 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years, up 1,500%, bingo, puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024. I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000, 7,000, etc. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits. Don't wait to the end, because it could happen. There could be like a little spike at the end. Each $1,000 gain is $1,000 gain. If you have an ounce of gold and it goes up $1,000 an ounce, you just made $1,000. That's real money. But because you're working off a higher base, each $1,000 gain is a smaller percentage than the one before. So when you move from $2,000 to $3,000 an ounce, that's a 50% gain. But when you move from 14,000 to 15,000, it's only a 7% gain. So that's why these bull markets get a lot of the gains toward the end, because 7%, that's a week. And then you're not gonna, you might have to wait a while to get to 3,000, but if you're at 14, you're not gonna wait long to get to 15. 7% could be a 1 week rally. So in other words, those $1,000 increments are smaller percentages and easier to achieve the further along you go. One more reason to get the gold now. Again, $1,000 is $1,000. It's the same amount of money, but it's a smaller percentage, which means it's easier to hit. And so the hard work is right now kind of getting to 3,000, 4,000, which it will, but it can really take off from there. $100 days are going to be the norm. $1,000 weeks are not going to be unusual, and they'll be more and more frequent as we move along. So that's one analysis. The second analysis is if you just use a monetary analysis. I'm not saying we're going to go on a gold standard. We may. Right now, there's not a central bank in the world that wants a gold standard. Not one. They hate it. But they may be forced to go to it or something like it, because if confidence is lost in government money and fiat money, they may have to turn to gold, not because they want to, but because they have to restore confidence. So what's that math? Well, the global money supply is about, I'm using M1 and the major economies, which is about 80% of the global GDP, is about 33 trillion. And there happen to be about 34,000 tons of official gold. That's not all the gold in the world. That's the official gold held by central banks and so forth. Well, you just do the division. Okay, divide the 33. Take the 33 trillion, and just say you need 40% backing. Some people would say 100%, but historically 40% has worked pretty well. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons and you need about $13 trillion of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look. The other one is a monetary look based on money supply. But interestingly, they come out in the same place. And then there are other ways of getting to the same answer. So that's I feel very strong. I feel it's a very solid kind of analysis to get to that number. But the other part of your question, Robert, is okay. What does it mean? Isn't this great? Well, gold's going up. I'm making a lot of money. Well, maybe you are, and other people are who have gold, and I certainly recommend it. But to me, the price of gold never changes. I think of gold by weight. You have an ounce, you have a kilo, you have a ton, you have a 400-ounce bar, whatever you may have. If the dollar price of gold is going up, what's really happening is that the value of the dollar is going down. Because gold is a constant store of value. So if all of a sudden, if $2,000 gets me an ounce, but we get to a world where it takes $5,000 to get me an ounce, what happened? The value of the dollar went down. I need 2.5 times more dollars to get the same ounce. So a high dollar price of gold is again, good for gold holders, but not close for celebration, because it means the complete and utter collapse of the US dollar. That's what happened in the 70s, and that's what's happening now. Well, a couple of things. The reason for dumping the banking shares is, I was the counsel at Citibank for 10 years, so I know a little bit about the banking business. The way you make money is you borrow short, lend long. You borrow at a low rate and lend at a higher rate, and you keep the difference. You got fees and credit losses and lots of complications, but that's pretty much what the banking business has always been. Well, if interest rates are zero all across the yield curve, in other words, if you're borrowing close to zero, maybe 25 basis points, and you're lending close to zero, maybe 1% or less, how do you make money? The answer is you can't. You can make a little bit of money, you can leverage it a little bit, but you don't make enough money to cover your credit losses and your expenses and your overhead and fees and a lot of other costs associated with that. So the flatter the yield curve, here's a 10-year rate, here's a overnight rate. If it's like this, you can make all this money in between. You're taking risk in terms of timing, but you don't have to take a lot of credit risk. But if it's flat, you can't make any money. So he's dumping the banking shares because they can't make money. Why would you buy Barrick? Well, he obviously likes gold. That goes without saying. But Berkshire Hathaway, which is Buffett's investment vehicle, is so big. We're talking, upwards of $1 trillion. You can't buy junior miners. Junior miners can be very, very attractive investments, but they don't move the needle at Berkshire Hathaway. You got to be spending $500 million just to kind of get on the list. Well, there are only a couple of mining companies in the world that are that big. Newmont, Barrick, IAMGOLD, there are a few, but that's it. So Buffett's not going to be able to buy junior miners anymore. He doesn't have the time and the ability to attract them. He needs a big name, and Barrick is one of the best. Interestingly, the way Barrick's going to make their money, they'll make money in gold for sure, and their stock price will go up, and it's a smart move by Buffett. But they're not going to make it by exploring. They're going to make it by buying junior miners. That's why for an investor a little bit smaller than Berkshire Hathaway, the junior miners can be attractive.